All right, let's jump right in. Financial stocks are finishing 2025 on an absolute high note, just riding this massive market rally that's taken everything to record highs. So there's a ton of good feeling out there, but you have to ask, can it really last? And get this, in the very last trading session before the holiday break, financials were one of the top performers, up about 0.5%. We're talking banks, insurers, fintech. They were all enjoying that end-of-year rally. But here's where we need to pump the brakes a little. That year-end momentum isn't always a great predictor for what comes next. As we turn the page to 2026, the picture starts to look, well, a whole lot more complicated. Okay, so to really get our arms around what's coming, we're going to focus on three huge forces. Seriously, these three things are set to define the entire financial sector next year. The big question of interest rates, a pretty wild split in global regulation, and, of course, the big test for the real economy. So, first up, interest rates. 2025 was all about central banks cutting rates left and right, and that gave the market a massive tailwind. But that whole easy money story, it's about to get a lot more interesting. And just to give you a sense of the scale here, it's pretty staggering. Central banks across the top 10 currencies cut rates 32 separate times last year. That all adds up to 850 basis points of reductions. It's the biggest global push for easier money that we've seen in more than a decade. No wonder markets loved it. And this kind of environment doesn't hit every part of the financial world in the same way. For banks, it's all about spurring loan demand and helping their margins. For brokers, it gets people excited to trade. Insurers feel it on their investment returns. And for all those fintechs out there, it can make their cost of funding a whole lot cheaper. But here's the catch. The easy part is over. Now, for 2026, we're facing what everyone is calling two-sided risk. Basically, it means nobody knows for sure which way rates are going to go. Will they pause? Will they slow down? Could some even start to go back up? That kind of uncertainty, well, it makes things a lot trickier for investors. Okay, let's move on to our second big force, regulation. And right now, this is just fascinating. We're literally watching two completely different stories unfold in the US and in Europe. It's a true tale of two continents. And this shows you the split perfectly. In the United States, the plan is to ease up, right? They're loosening the rules on how much cash banks need to keep on hand as a cushion. That could free up something like $13 billion for the biggest banks. But then you look at Europe, and it is the polar opposite. They are tightening the screws, cracking down on risk, and they're even talking about making one single bank, UBS, hold an extra $26 billion. Just a huge difference in philosophy. And the story in Europe isn't just about the big traditional banks. The next big regulatory wave is all about digital money, and that's something that could fundamentally change how we all pay for things. And listen, this isn't just some theory they're kicking around. The digital euro is on a real concrete timeline. You've got the ECB fast-tracking some approvals as early as January, with a full pilot program aimed for 2027. This could have massive ripple effects through the entire banking system. Okay, so this brings us to our third and final force, the real economy. We've heard this phrase, soft landing, for so long now. Well, 2026 is where that idea really gets put to the test. The big question is, can the consumer, who's been so strong, keep it up as we start to see stress building under the surface? So let's start with the good news, because the consumer does look really solid on paper. The holiday spending data from Visa and MasterCard was strong, up around 4% from the year before. That's a very healthy number, and it's fantastic news for anyone in the payments business. But, and this is a big but, while we're all out there spending, regulators like the FDIC are waving some warning flags, and they're pointing to some very specific areas where stress is building: commercial real estate, auto loans, and credit card debt. And look, if people start defaulting in those areas, banks have to put more money aside for losses. That hits their profits, and it might make them less willing to lend. So it's this really interesting contrast. You've got these pockets of stress, but at the same time, the banking sector as a whole is still incredibly profitable. In fact, the FDIC reported that U.S. bank profits actually jumped over 13% in the third quarter of 2025 to almost $80 billion. That resilience is really the core of the argument for being optimistic on this sector. So you put it all together, a shifting interest rate picture, regulations going in opposite directions, and an economy that's strong in some places and weak in others. Let's try to boil it all down and figure out what we should actually be watching for in the months ahead. Okay, Here's your checklist for 2026. First, you've got to watch fourth quarter earnings and, more importantly, what the CEOs say about the future. That's going to set the tone. Second, keep a close eye on those credit numbers, especially in commercial real estate and auto loans. Are the cracks getting bigger? Third, look for what companies do with their cash. Are they buying back stock, raising dividends? That tells you how confident they really are. And finally, you got to stay on top of any new rules for digital money and AI, because those could be total game changers.
So, the big takeaway here is pretty clear. Those tailwinds from 2025 were absolutely real, but the tests coming in 2026 are just as real and probably a lot tougher. The easy gains are likely in the rearview mirror. And that leaves us with the one big question for the year ahead. In this new world of rate uncertainty and clashing regulations, who is actually built to win?